Good afternoon. I'm Joyce Barrett. Welcome to today's webinar. Webinars are brought to you through the generosity of Heritage Ohio supporters. We invite you to join us by visiting the Heritage Ohio website. Heritage Ohio's mission is helping people to save the places that matter, build community, live better. Our upcoming webinars, December 8th at 1 o'clock, we'll have Using the Secretary of Interior's Guidelines for Rehabilitation to Guide Your Project. And on December 15th at 1 o'clock, we'll be hosting SBA, the Small Business Administration, on their new economic injury and disaster loans. Today's presentation is on tax incentives for fire safety improvements. This is a great opportunity to reactivate vacant space and make all of our historic buildings safer for occupants. We have AIA HSW credits. Those are in the chat. If you look at your panel on the right-hand side, there is a chat bar, and I have listed the document that you need to fill out to get your AIA credits. Also, you'll see in the handouts on your control panel to the right, there are two handouts. They're a copy of the PowerPoint presentation being given today, and there's also a handout from the National Fire Safety Association. We will be taking questions at the end of the presentation. If you have any questions, type it into the question box as you're thinking of it. Later this afternoon, you will receive an email from GoToWebinar with a link to the recording to this webinar, which you're welcome to share. We also post our webinars on the Heritage Ohio YouTube channel. Our presenters today are Ron Ritchey, Tom Boccia, and Nick Gerhardt, who will each give a brief introduction of themselves. And with that, Ron, you have the controls and you can take it away.
Well, thank you, Joyce. And we'd like to welcome everybody who's joining us with us today. We wish we could be with you in person, but we certainly recognize the benefit of being able to do these offerings virtually. So just real briefly about myself, I'm with the National Fire Sprinkler Association. I cover 5 states, including Ohio, Indiana, Kentucky, Michigan, and West Virginia, and I teach across the country, put training classes on. And today we're excited to talk to you about tax incentives, and really excited to be able to join up and partner up with both Tom and Nick, who I will allow to briefly introduce themselves, and then we'll get started.
Thanks, Ron. Welcome everybody. First of all, thank you for attending. My name is Tom Boccia. I am a CPA in Cleveland, Ohio. I'm a partner with the firm Novogradac and Company out of their Cleveland office. And our firm, we're a full service CPA firm that specializes in real estate and various other tax incentives that helps developers and property owners sort of maximize some of the benefits and helps ways to bring additional funding into projects and to help them make them successful. I've been doing this for over 30 years in the tax credit world. I specialize also in historic tax credits and various other tax credits as well as other incentives that we'll talk about here on the webinar. And I've got my associate, Nick Gerhardt, as well, and Nick will tell a little bit about himself.
All right, thank you, Tom. My name is Nick Gerhardt. I'm a manager also in our Cleveland office of Novogradac. I graduated from Cleveland State University, and I actually started as an intern here at Novogradac in January of 2014. So been through 8 busy tax seasons now. It's kind of flew by, and I've gotten to work pretty extensively with the low-income housing tax credit, the historic tax credit. Also have done a little bit of financial modeling related to the new market tax credit, and do a little consulting related to opportunity zones incentives. So a little background about me, so I'll hand it back over to Ron.
Well, again, we're going to be talking about the Federal Fire Sprinkler Tax Incentive Act, and I'd like to talk a little bit about kind of the history of this. National Fire Sprinkler Association was very integral in having this come to pass. It actually took us 14 long years to be able to get this passed, and it resulted from the Rhode Island nightclub fire that occurred in 2003 that killed 100 people. And as in most things, cost comes down to be an issue when we're talking about safety. And that's no exception when we're talking about fire sprinklers. And so the team here that's pictured here, along with a lot of other the groups here that are listed here, we all work together long and hard, but the National Fire Sprinkler Association was the lead organization that was able to finally get this passed in 2017. And with it, it certainly allows fire sprinklers to be installed with a lot less expense. And that's always a really good thing. The National Fire Sprinkler Association, we pride ourselves as being the voice of the fire sprinkler system. We're all-inclusive association. We have contractors, suppliers, manufacturers, fire officials, group individuals. It's all-inclusive, and we're very involved in all types of legislation at both the national and state levels. So just a little bit of history. Again, this thing was passed in 2017 finally, and it was a very, very exciting time for us. And Tom and Nick's going to get into this a little bit in more depth here in just a little bit, but one of the things that it covers is qualified real property. And they're going to talk about that, including installations for new buildings. It covers upgrading for existing sprinkler systems if you're going to upgrade those, or you're going to retrofit an existing structure. Now, one of the things that we need to point out is residential sprinklers are exempt, and Tom and Nick will cover that a little bit later. There's some guidelines as far as how you can meet that, or what is an exception. They'll get into that here in a little bit. But the key here is in the coronavirus, and as we've all been battling here for a number of years, there was a big Economic Stabilization Act that fortunately we were able to get in and do a slight technical correction on. Fire sprinklers was actually accidentally left out because it was pushed through the last minute in 2017 as part of bonus depreciation. It was never meant to be that way. It was a typo, but it still had ramifications for us. But fortunately in 2020, that was corrected, which we're really happy to talk about and report on. And Tom and Nick's going to be getting to this in a lot more detail here a little bit later following me, but there's the tax deductions for Section 179 laws and tax deductions for Section 168 laws. This 179 section covers, it's a permanent law that you know, as far as anything, I guess, is permanent in this country, but it has no time frame or no time lapse on it. Whereas this bonus depreciation that we're going to be covering, the Section 168, is time sensitive. And in fact, you're going to find out that this upcoming year will be it's critically important to try to be able to deduct 100% of your accelerated deduction for the initial installation, which was a key component of this bill. And then beginning in 2023, it'll be dropping 20% in 20% intervals each and every year till year 2026, when it'll basically then phase out altogether. So having said that, I will now turn the time over to Tom and Nick to get into the details. And Tom,
this is Tom. Yeah, thanks, Ron. And before I turn it over to Nick, I just wanted to just go back to that one slide, Ron, for a second.
Yeah, sure. Yeah.
It's all about how fast can you recover your costs. So as a property owner, or as a developer, you're having to capitalize all these costs into your property, and you've got these really long, under old law, 39-year depreciation for non-residential, or 27.5 years. So it takes you a long time to recover whatever dollars you put into it. So these incentives, what we're going to talk about is how can you accelerate those deductions so that you can get some tax benefits and recover income taxes you've paid, or reduce your income tax liability to help cover the cost of doing these improvements instead of having to spread that over a long period of time. So that's really the genesis behind all this, and it's really about what we're really going to talk about. So with that, I'm going to turn it over to Nick, and we're going to get into a little bit more of the details of the specifics on how each of these rules work.
Thank you, Tom. All right. All right, so we have a little disclaimer slide in here that all of you can read on your own time. Before we dive too deeply into the technical intricacies associated with the federal tax incentives that we're going to be discussing today, we wanted to start off with defining some of the terms that we'll be referring to throughout the presentation. And as Tom mentioned, these incentives are really kind of different forms of cost recovery. So starting off with bonus depreciation, which was established as part of Internal Revenue Code Section 168. It's a little misleading, the term bonus depreciation, because it's not really extra depreciation. It's more so front-loaded or accelerated depreciation that you get to kind of take upfront when your project is placed in service. Similarly, 179 deduction is another kind of accelerated depreciation that's available for certain kinds of capital assets. So as opposed to these first two items, the traditional depreciation useful lives for non-residential and residential buildings are a pretty long period. So for residential properties, it's typically a 27.5-year useful life that you're depreciating those costs over. For non-residential properties, it's actually a combination of both 15 and 39-year useful lives. And of significant importance, at least for today's presentation, is this 15-year category. Because these first two items here on this slide, bonus depreciation and the 179 deduction, are only applicable to that 15-year asset category, which we'll dig into a little more in depth as we go through the presentation. All right, so this was in the slide deck that you received for your handouts. And this was actually like 2 slides before, but we figured we should give you a little brief overview of what bonus depreciation is before we actually talk about the phase-out rules related to these. So we'll talk about these phase-outs a little more in depth, but essentially there's a 100% bonus depreciation rate through the end of 2022. And then starting in 2023, instead of being 100%, the applicable fraction that you can multiply your overall cost by is going to be reduced each year. So again, this is a time-sensitive incentive that really needs to have action taken if you want to get the full benefits of the 100% deduction.
Yeah, and the big takeaway from this for our audience is 2023. So you got 1 more year and 1 month, basically, to do some of these improvements and get them in service and take advantage of the 100% as it scales back, 80% starting 2023. So if you're contemplating any of this, maybe this is a way to really be thinking about, I'm going to get a little bit better tax benefit if I get this work done and placed in service before the end of 2022. So it's something to be thinking about if you for your property owners and you have plans to make improvements to a building. Time is somewhat of the essence as this benefit starts to erode as the years go by.
All right. So next thing we wanted to cover, because again, these tax incentives that we're discussing are really only applicable to non-residential properties. So we thought it made sense to kind of define what non-residential versus a residential real property improvement is. So the IRS Internal Revenue Code, Section 168, defines residential rental property as any building or structure from which 80% or more of the gross rental income for the tax year is from dwelling units. So this is especially important for mixed use buildings where you may have both commercial and residential units within the building. And so really you're going to be needing to look at the gross rental income from both the commercial and rental units. And if more than 20% of your gross rental income is from the commercial units, then you can classify that building in whole as a commercial rental property.
And Nick, I'll stop you right there. That's a huge important factor for property owners. And let's say you have a 4-story building, for example. First floor is retail, upper 3 floors are apartments. Depending on your rent mix and how much rent you're getting from the retail, if more than 20% of the income is coming from that first floor, the entire building is considered a non-residential building, and you get some of this favorable depreciation treatment, what we're going to talk about here, this qualified improvement property. You don't split the building into two components, the residential. So that's the only, this is really a situation where you could take residential property and take advantage of these non-residential rules. But again, you have to meet the income tests in order to do that. So something to be thinking about is for a lot of you, for the properties that you own.
And I want to interrupt. We do have a question from Terry, and I think you just answered it. The question was, when you say non-residential, are you simply referring to the commercial building code that actually includes multifamily structures?
No, so non-residential doesn't follow that. In the tax code, it's defined differently. It really goes to the source of the income that's generated. So if more than 80% of the income for a building that you own is coming from multifamily units, from apartments, let's say, then that entire building is going to be considered a residential building. It doesn't go to the building code, or it doesn't go to any of those other. The IRS has their own definition of exactly what defines residential versus non-residential.
Yeah, and that's a great point, Tom. It was a great question too, because when you look at it from a purely building code or fire code type of situation, 20% is based upon area, not based upon cost. And I think Tom's making that point now. It's more, your 20% of your is based upon your cost, not the square footage in your building.
Actually, it's not the even cost. Sorry, it's actually the income that you generate.
I'm sorry, the income. Sorry, yes. Wrong term.
No problem.
So please write in the question box if somebody has not got that clear. We want to make sure you really understand what that means. I think you can go ahead. I think we got it.
All right, thanks, Joyce. Last bullet point here just kind of makes it a point to state that hotels and motels are not going to be considered residential rental property. So those would be eligible for qualified improvement property treatment and be classified as commercial property. And right underneath that bullet point is a little more information about kind of what the code defines as a dwelling unit.
And
you mean the IRS code, not the building code?
Yep, sorry. Great clarification, Joyce. Yep, Internal Revenue Code. All right, so qualified improvement property, which is one of those 15-year asset categories that we mentioned earlier, is any improvement to an interior portion of a building, which is non-residential real property, if such improvement is placed in service after the date such building was first placed in service. So this is a really important part of the definition of this qualified improvement property category. It's really saying that this is applicable only to interior improvements made to existing commercial buildings. And these improvements have to be made after the building was originally placed in service. And then the code actually also excludes certain kinds of improvements from being classified as qualified improvement property. So it excludes costs related to enlarging the original footprint of the building. Costs related to elevators and escalators are excluded, as well as internal structural framework costs related to the building.
So it's pretty clear here that the Congress wanted to incentivize taking existing properties and redeveloping them or improving them versus giving tax benefits to new construction. So with this change to allow for 15-year, either the 15-year category, which is a qualified improvement property, which had previously been 39-year property, and we'll get into that in a little bit more. It really was Congress's way of trying to save existing buildings or retrofit existing buildings versus looking at brand new construction, because a lot of the older buildings, as Ron, you probably could attest to more, aren't equipped properly and are really in more need of this versus new construction, which has its own new set of rules.
That is correct. And I don't know if this is the time or place, it may muddy it up a little bit, but I don't know if you want to touch on the difference between qualified improvement property versus qualified real equipment, or those terms, I guess, that we talked about earlier yesterday, Tom.
Yeah, Ron, we're going to actually get into kind of what the definition of qualified real property is in a few
Okay,
slides,
great.
but
Okay,
yeah,
thank you.
that's a good way to preface it is there's actually another kind of category called qualified real property, and qualified improvement property is really a subset of that category. So qualified improvement property is qualified real property, but we'll kind of go through that in the upcoming slides.
And like every good tax provision, it tries to be as confusing as possible to people. And I think this whole concept of qualified improvement property and qualified real property, there are some subtle differences. To the average person, they don't seem like there's subtle differences, but unfortunately they are. And it's just another way of making the tax code even harder for folks to figure out. But we'll get into that in a second.
All right, so now that we laid a little bit of a foundation, we're gonna start going through some more of the rules surrounding bonus depreciation. So first, only certain kinds of property is eligible for bonus depreciation. Again, this isn't applicable to building assets that have a 39 or 27.5-year useful life. This is only applicable to property with a recovery period of 20 years or less. Internal Revenue Code also points out some other kinds of property, such as computer software and water utility property, that could also qualify for this bonus depreciation treatment. Another thing to point out is property depreciated using ADS, which is a form of tax depreciation, is not eligible for bonus depreciation. And this really comes into play when you are considering interest limitations and something called the 163J election, which, there's a lot of rules surrounding that. So that's not in the scope of this webinar today, but that's just something to keep in mind, is if you are considering making a 163J election to opt out of interest limitations, then you kind of are forced to use this ADS method. And when you use that method, you're not eligible for bonus depreciation. Property placed in service and disposed of in the same tax year is also not eligible for bonus depreciation. And again, to reiterate, a newly construction property would not be qualified improvement property, and therefore you would not be eligible for bonus depreciation. In this slide, we won't touch on very much, but it provides a little more background about the Tax Cuts and Jobs Act, which Ron mentioned at the beginning of the presentation. Pretty much kind of condensed a few different 15-year asset categories into this one category called qualified improvement property.
And just to touch on that, and Ron had alluded to it at the very beginning, this is where there was these three different categories of property prior to tax reform at the end of 2017 that got passed. And through a drafting error of all things, they created this one category. Well, this wasn't the drafting error part, but they created qualified improvement property. But because of a drafting error, qualified improvement property was supposed to be 15 years and eligible for bonus depreciation from the get-go. Well, because of a drafting error, it got put into the 39-year category, as the previous slide showed. Well, 39-year property is not eligible for bonus. So all these types of improvements that these fire sprinkler systems they would put in place, and other types of improvements to the interior of a non-residential building wouldn't qualify for bonus. And so there was a big fight on with Congress to get this all fixed, and we'll talk about that in a minute. But this is sort of the genesis behind it. It was supposed to be there from the beginning of 2018, a drafting error. It took this benefit away, and a lot of folks in the industries, all these industries, worked diligently to get this corrected, and finally we did.
All right, and then that drafting error that Tom just mentioned, that was actually corrected through the CARES Act. So it was assigned a 15-year MACRS depreciation recovery period, and it would be 20 years if you're using the ADS method. And bonus depreciation is going to be equal to 100% of your total improvements through the end of 2022. So again, to kind of hit the point across, this is a time-sensitive incentive that really only need to do these improvements and have it placed in service before the end of 2022 in order to get the 100% rate for bonus.
And Nick, the retroactive, doesn't that go back to the 2017 date original, I believe it was?
Yep.
The application.
Correct. That
Okay.
was kind of more important when there were the transition rules for projects like right near that time that the Tax Cuts and Jobs Act was passed.
And so that's important for those of you who maybe in 2018 or 19 or even had made these types of improvements, weren't able to take advantage of these. You can do that now by going back and doing a retroactive application of these new rules back to 2018. You would have to take it, you would basically file a form, it's called a change in accounting method, and you do a cumulative adjustment. And so you would be able to take advantage of that on your 2021 return if you haven't done so already in like a 2020 return. But it's key. If you've done these improvements, you should think about it and look at whether you were able to take advantage of it or not.
All right, so we've mentioned a few times now that this 100% bonus depreciation is only applicable through 2022. So what happens after that? So the IRS provided us with this kind of applicable percentage table showing kind of what the percentage you can use for bonus depreciation will be phased down after 2022. And something to note is written binding contract rules do apply. So one of the requirements for taking bonus depreciation was the property had to have been purchased after that September 2017 date that the Tax Cuts and Jobs Act was passed. Certain qualifying property with a longer production period would also gain an additional year from the dates shown above. And then again, to reiterate something we mentioned earlier, bonus would not be available if a 163J election was made that would require you to depreciate your building assets under ADS lives, including qualified improvement property, which would then exclude the property from being eligible for bonus depreciation. So what does all this mean? What's kind of the advantage of bonus depreciation is it lets you, depreciate a lot more of the costs upfront immediately when you're placing that property in service. So being able to take those depreciation deductions will reduce your taxable income, which should reduce your tax liabilities, which should provide more cash flow, equaling tax benefits.
Yeah, it's all about the benefit, the tax, trying to get it using a tax benefit to help offset the current cost of these improvements. And we'll get into some examples after we go through the next section here. But it's about the tax benefits helping reduce the cost to make an improvement. So for every dollar that goes into it, if you can get that on a present value basis, that tax savings much earlier than over a longer period of time, that just helps on an after-tax basis.
I'm going to interrupt with another question just because we've had it asked twice. To confirm, can nonprofits take advantage of this through filing a 990?
Well, because nonprofits are not taxpayers, they don't pay federal income tax. Technically, yes, they can, but they're the same benefits there, unless they would own property and it would be subject to unrelated business income tax. But in general, nonprofits would use the same depreciation methods, but they're not a taxpayer. They don't pay federal income taxes on their income, so they're not going to get the same benefit as a corporation or an individual that would actually have tax savings because of it.
One of the inquiries was from a VFW facility, and I have no idea if that's unrelated income, on owning the building.
Right. It all depends on your mission, and the unrelated business income tax for nonprofits is a very complicated code section, and so it's beyond the scope of this. But if that were the case and you had it and you were owning real estate, it may be subject to that because it's not maybe part of your mission, and then this would be a benefit in that case.
I have another question, which is a review question here before we get going too much further in. Please describe the binding contract again. It sounds like the building had to be purchased after 2017.
Correct. Yeah. So the written binding contract rules are basically, in order to take advantage of this, you would have had to have purchased the property after this law was passed. So if you can prove that you had a written contract in place before the incentive was passed, you can kind of rely on that to take advantage of the incentive.
But is that binding contract different? Because if you've owned this building for 50 years, you can still upgrade it, right? It's just binding contract's a different accounting method.
No, so I think the binding contract in this case would be under the phase out rules would be if you started to do the improvements, say in 2022, and you entered into a contract with somebody to do those improvements, but you didn't place them in service till 2023, you would be subject to that binding contract under that scenario. I think the acquisition of the building, how long you own the building, obviously you have to have owned it before because it's not subject to it's not new construction. But these binding contract rules, and we'll clarify that, Joyce, and we can send out an email to you and you can forward it on to the participants. But the binding contract rules here refer to the timing of when you may have started, when you entered into a contract to do this work, and which phasing are you going to be eligible for, one of like the 100% category or the 80%, depending on when you actually place it in service and when you entered into the binding contract.
Right. So the binding contract is for the service had to have happened after the law went into effect in 2017. It has nothing to do with the ownership of the building, so to
Correct.
speak. Yes.
It's the binding contract of the improvement of the contract entered into for the improvements, not for the ownership of the property. So it's for, so you hire a contractor, for example, you enter into a contract with a contractor sometime in 2020, let's say in October of 2022. And normally, if this binding contract rules were to apply and you finished the work and placed it in service in 2023, you'd be only eligible for 80% of the bonus depreciation. But because of the binding contract rules, if you had a contract in place, you go to that's the year that you're effective as of. And so you would get 100% bonus depreciation under those rules. When you bought the building is not really relevant. Okay. Any other questions?
No, nothing. We'll save the other for the end.
All right. So now that we've discussed bonus depreciation, we're gonna kind of move into the other incentive we're discussing today for the 179 deduction. So tax law has long allowed small businesses that meet certain criteria to deduct fixed asset additions, often referred to as 179 deductions, up to certain thresholds. Now the Tax Credits and Jobs Act kind of increased some of the limitations, made them a little more favorable, but there's still a lot of limitations that significantly limit the ability of taxpayers to kind of take advantage of this incentive, which we'll be discussing here in the next few slides. So first, what kind of property is eligible for this 179 expense? In other words, what is Section 179 property? So Section 179 property is tangible property or computer software that is acquired by purchase for use in the active conduct of a trade or business. And that property has to be Section 1245 property, which is generally personal property. So things like machinery and equipment that's movable. But Section 179 can also include qualified real property if elected, and that is the term Ron mentioned earlier, and I said we would be getting to shortly, and here we are. So qualified real property, as I mentioned earlier, it includes that qualified improvement property category that we defined on an earlier slide, which said was non-residential interior improvements placed in service after the original property was first placed in service. But then the Internal Revenue Code also allows qualified real property to include the following non-residential real property improvements also placed in service after the date such property was first placed in service. And that is roofs, HVAC, fire protection and alarm systems, and security systems. So here's the big thing that we are trying to focus your attention to today on is the fire protection and alarm systems category. So this definition gets a little muddy and confusing because kind of these improvements that it's talking about that qualify as eligible also kind of can also in some cases meet the definition of qualified improvement property. So you might have fire protection, safety equipment improvements that could qualify as qualified improvement property themselves. But one thing to kind of remind everyone of is there were a few kind of asset categories that were excluded from the definition of qualified improvement property. So that was things like additions related to enlargement of the original existing footprint of the building. So this kind of definition allows a little more flexibility with kind of being able to classify costs under this shorter cost recovery method.
You know, my takeaway from this is there are obviously two choices here, and we'll get into the limitations. 179 is that while bonus depreciation is 100% cost that qualify as bonus depreciable items, or you can claim 100% of it through 2022, it's much easier to qualify for that, and we'll show you in a minute why, than 179. And 179 rules get a lot more complicated. So what I always advise clients is let's just treat this with bonus depreciation. When bonus flips and becomes less advantageous, then we'll start looking at 179 again. And Nick will get into a little bit about more of the specifics on the 179 and why and you'll see in a minute here why it's much more challenging to qualify here. But just the whole point of this, you do have options here and how you can actually qualify.
Yeah, and before moving on from this slide, maybe a better way to kind of summarize this qualified real property is, you know, although buildings themselves do not qualify for 179 deduction treatment, qualified real property, you know, includes a list of items that otherwise would be depreciated with the building, but now can be depreciated as separate, distinct depreciable assets that can use that shorter recovery period. All right, so let's start talking about all the limitations involved with this incentive. So first, there is a maximum amount that you can expense for the 179 deduction. Before the Tax Cuts and Jobs Act, the limit was $500,000 per year. It was increased to $1 million. And again, as Tom just mentioned, this is kind of important, this limitation, because when you compare this to something like bonus depreciation, which has no limits, you know, this really kind of limits the availability of this. So in addition to that $1 million cap on the overall 179 deduction, there's also limits related to the actual 179 property that's acquired during the year. And these phase-out limitations come into effect once you are acquiring more than $2.5 million in 179 property during the year. And how the phase-out kind of works is it reduces the deduction available dollar for dollar as you go over that 2.5 million threshold. So the slide kind of points out kind of how that works, where taxpayers with up to $2.5 million in qualifying 179 property are eligible to claim that full $1 million. And then once you get above and you're in between 2.5 million and 3.5 million in qualifying 179 property, you're going to have a reduced amount of 179 deduction that you're able to claim. And then once you get $3.5 million or more, that's when you're now $1 million above that 2.5 million threshold, and your overall limitation is $1 million. So because the phase out kind of reduces dollar for dollar, once you get to $3.5 million, then you're not eligible at all for any 179 deduction.
So the big takeaway on this part of it is, what's the size of your project that you're going to do? If you have a building, you're maybe just retrofitting a certain part of it, you may meet these thresholds pretty easily, and the decision's a lot easier. But if you have a building, you're doing a full, complete rehabilitation, because it's not just like the fire and sprinkler systems. You have to look at all the costs that you put into that rehabilitation that would qualify under these definitions of qualified improvement property or qualified real property. And if that total exceeds that 3.5 million, you can't even use 179, and now you're back to the bonus. And that's why I was saying before that it is much simpler to qualify under the bonus rules than it is under these rules. And this is really aimed at more, smaller retrofitting of buildings, or much smaller projects. Again, because you have to take in consideration everything you do in that one particular year, not just a specific type of work like putting in the sprinkler system or something. So it's critical to understand that and know the project size and which way you're ultimately going to go with this.
And something else to point out on this slide is this first kind of sub bullet point about this having to be applied to both the partnership and partner level. And this is particularly noteworthy because you might have a partnership that has a large corporate investor with large amounts of qualifying 179 property at the corporate level that also own multiple partnerships with their own qualifying 179 property. So it is overwhelmingly likely that in any given year, the $3.5 million threshold will be breached, which would effectively eliminate the ability of the investor to claim any 179 deductions. So for any partnerships in which they own, an allocation of 179 deductions would pretty much be fruitless because the deductions couldn't be used by the investor. All right, so if you weren't too concerned with the limitations that we discussed so far, we have one more big one, which is that a 179 deduction is going to be equal to the lesser of taxable income without regard to the 179 deduction or the 179 deduction. So essentially this means if there's an overall net taxable loss, you're not going to be able to claim a 179 deduction. And for many taxpayers engaged in a real estate trade or business, due to depreciation deductions, which dramatically reduce the taxpayer's taxable income, this limitation is likely to severely limit their ability to claim 179 deductions.
So for example, to just give a real broad, high-level example, if you're a taxpayer and you own a building and you did $1 million of improvements that you wanted to take advantage of this, and you'd have to have $1 million of income, taxable income, before this deduction in order to take the full deduction, which is really the challenging part. So 179 is just full of much more other factors that make it very difficult for a lot of taxpayers to use, because you not only just take this project in consideration, but you have to look at all of your income sources or all your net taxable income, and you just may be limited. Again, why the bonus depreciation is so much easier to use and has less hurdles that you have to overcome.
All right, so that was a material we had on the 179 deduction. I guess I'll pause real quick. Joyce, do you see any kind of questions we want to address related to the 179 deduction at this point?
Well, yes, let's go back. We have two questions, and one I think I answered appropriately. If you have multi-use building that contains residential It is eligible, but 80% of the income comes from the commercial rental portion of the mixed-use building. Correct?
So say that again. I think the percentage
Okay.
might have been reversed.
If you have a multi-use building that contains residential,
Yep.
is it eligible? And you would answer,
So if more than 20% of the gross rental income is coming from commercial units, then you could classify the building as a whole as a commercial property.
okay, more than 20% of the commercial. So that's fairly generous because there are a lot of buildings that are probably 20/80, kind of at that level, right? Right.
Yeah,
The,
historically speaking, yeah, it's a challenging hurdle. If you really have a multifamily building and you have a small piece of it, you, like I said, like you have a couple units there that may be retail, it is really hard to get over that hurdle. But if you have a true mixed use where, maybe, it's a half and half or so on and so forth, then you're easily going to qualify under the entire building being non-residential.
right, okay. And the other question we have is a request to explain how depreciation works. And I think that you can roll that in when you do your examples next.
And
Yeah, sure.
I would have just one request for Tom and Nick, and again, not trying to muddy this up, and I know we're running out of time, but earlier I talked about the new installations, and there was some very limited opportunity for new installations. That would be part of the 179 portion of it, right? That's more complicated, correct?
Can you repeat? Say that again, Ron?
Yeah, at the beginning, we talked about the scope of how you could use these deductions. And I mentioned, we had retrofit and so forth. And I mentioned new construction, and there was some very limited application to that. I just wanted to make sure that I didn't, I want to make sure I was clear with the folks when we started the program off. We talked about it yesterday.
Yeah, again, others may have different opinions, but my take on the new construction is a building that was placed in service and may not have put in sprinklers for some reason, but a part of the building was placed in service, and then you went back in after the fact and did that, or did an improvement to something that's existing in there. But I have not been able to find in the code where from the ground up, brand new construction, everything full in, that you would ever, that these costs would qualify in that situation.
Okay.
And it may be situations where you do a building, and then as you're doing tenant build out,
yeah,
you're doing each individual tenant build out, because you might not sprinkle the entire, you might sprinkle the common areas first,
right,
and then you might go in later on and do all the tenant build out later on as you get tenants, and doing that, you definitely would qualify that in that situation.
Excellent, thank you.
Sure.
All right. So we also wanted to kind of present a little bit of material about the historic tax credits program that's available, which also provides another kind of tax incentive for projects that are historically rehabilitating a building. So we don't want to spend too much time on this slide, but we wanted to kind of give a decision tree of kind of the considerations you need to think of when you have a historic project, and you're considering, maybe taking bonus depreciation on that 15-year asset category that we discussed, known as qualified improvement property. So one of the first considerations you're gonna want to make is whether the property has interest expense and whether it's subject to kind of all the interest limitations that are out there. So again, 163J is a pretty complicated rule, so we don't want to get too much into detail on that, but you definitely want to kind of consider whether a 163J election would be made, because that would obviously then make your building assets, including QIP, subject to the ADS lives, which are not eligible for bonus depreciation. And another point to consider too is if you're going to be claiming historic tax credits on a project, you aren't allowed to claim bonus depreciation on the 15-year property and also receive tax credits. So it's kind of like an analysis that needs to be performed to see kind of which would be more beneficial for the project.
Unfortunately, the way the tax code works, there's no double dipping here where we get both a bonus depreciation and tax credits. Unlike the low-income housing tax credit, where you can take bonus depreciation on site improvements and personal property and still get the low-income housing credit on that. The historic world doesn't have as good a lobbyist apparently in DC, and so it's an either-or situation, and we're going to Nick will go into in a second. Here are some examples of how you might want to look at evaluating which decision you want to go with.
All right, so now let's put some numbers in an example to help make this a little more clear. All right, so this slide here, we're basically kind of showing a scenario where a property might be claiming historic tax credits on all of their improvements. And in this scenario, we're assuming that there's $3 million of improvements that are all going to be considered qualified improvement property. And you'll see in this assumption at the top of the slide here, we're also throwing out the term qualified rehabilitation expenditures, and that's also known as QREs. That's something that is kind of the eligible basis of cost that you can claim historic tax credits on. So if we assume in this first scenario, we have $3 million of improvements that are qualified rehabilitation expenditures for the historic tax credit incentive, and we're assuming this is all qualified improvement property. The federal percentage you can take for historic tax credits is 20% of your qualified costs. So in this scenario, if we have 3 million of QREs, we would earn $600,000 of federal historic tax credits. We'll also assume in this case that the project also qualifies for state historic tax credits, and oftentimes the percentage for state historic tax credits is a little bit above the 20% rate for federal purposes. So here we're assuming 25%, which would earn $750,000 based off of the $3 million of QREs. So here we're saying that total HTCs in this scenario would be about 1.35 million. So also to take into consideration is the cumulative depreciation that will happen over the life of that improvement property. And to kind of touch a little bit on the question Joyce just mentioned. So what depreciation is basically the cost that you incur to rehabilitate a project or to make improvements to an existing project. Those costs, the IRS code basically says you need to capitalize those. So you're going to record that as an asset. And then to recover those costs via expense, you're going to essentially depreciate or divide the total cost over the useful life of that asset. So in this case, if it's qualified improvement property, the designated useful life for that is 15 years. And if you are claiming historic tax credits, you're not going to be eligible to take bonus depreciation on that. And we have a little asterisk here. First of all, we're noting that this is undiscounted, so it's not taken into account the time value of money. This is just going to be the cumulative depreciation over a 15-year period. And you'll see that this 2.4 million is less than the total $3 million of improvements. And that difference is the $600,000 of federal historic tax credits. Essentially, the IRS makes you reduce the basis of your property by the federal historic tax credit amount, so you won't be able to depreciate that portion. So we're just showing 2.4 million in depreciation benefits. And if we assume a federal tax rate of 37% and a state tax rate of 4.25%, the tax savings just related to that 15 years of depreciation would be $990,000. So the total benefits, adding that 990,000 plus the 1.35 of historic tax credits, shows total tax benefits of 2.34 million. So then if we look at a case where you would want to claim bonus depreciation on that qualified improvement property in lieu of claiming historic tax credits, we see that you would get bonus depreciation on that QIP immediately in year one, assuming that we're still before 2023 and have that 100% rate. So the tax savings related to that $3 million that you get to depreciate all in the first year is going to be this $1,237,500. And again, this when we now look off to the side, we're showing kind of the excess benefits related to claiming historic tax credits over bonus on QIP. It's a little more inflated, the HTC, because we're not taking into account the time value of money with, you know, this total being depreciated over 15 years versus immediately all in 1 year. But you can still see that there's significant benefits to claiming historic tax credits. All right.
And Nick, we can skip the next one because it's basically the same thing, except for we just took the state tax credits out of there, so you can kind of all see that. And you'll have that all in your handout. So it's just, again, it all depends on, the whole point of this is depends on your personal tax situations. There's options out there that looking at the benefit of the credit versus claiming the full amount of the bonus depreciation versus depreciating something over a period of time. And when we say depreciating, we talk about whatever you paid for that asset, you have to write it off. If it's a 15-year asset, you would take 1/15 of it every year as a deduction. If it's a 39-year requirement, then it'd be 1/39. So it's how you spread that cost out as a tax deduction over the life as required under the Internal Revenue Code. So that's what depreciation is. It is spreading out the cost over a period of time versus the bonus, and where you get to take it all up in 1 year. So that's the difference between what depreciation is and a normal depreciation and then the other way. So I can go to the summary now, Nick.
Sure. Yeah, so we left a few more slides in here. Some are from Ron's presentation material. And this is really kind of just hitting the points that we've already covered up to this point. So we won't read through each of these slides, but you have these in your handouts. We want to leave a little bit of time for some questions here. So
you want to go through the example? That's
yeah,
sure.
Okay. So here's a little sample. Assumes we have $250,000 in fire sprinkler improvements. So you see that if we were to qualify for the 179 deduction in this scenario, you would get to immediately expense or recover all those costs in year one. So then if we assume a 35% tax bracket, that multiplied by the $250,000 shows the cost savings related to that 87, related to taking that 179 deduction up front. Which then, you know, if you take into account those tax savings, then it really kind of lowers your overall cost of those improvements. If we look at a little higher amount of improvements, you can see that the tax savings just increase even more. So this is just still assuming we're just doing a 179 deduction. You can see how with that increased cost, our savings also have increased. And then here, this last example kind of shows a scenario where maybe the improvements would qualify for both bonus and Section 179 deduction. And again, you can see when you're kind of showing the tax savings related to those expenditures, you know, these incentives provide a lot of value. So yeah, that was it. Ron, feel free to jump in and add any more color to those slides. But.
Yeah, I think you did a great job in explaining that, Nick and Tom. And then I guess, Joyce, any other questions that you have or any of the attendees have?
We'll ask all of our audience to type in the questions that they might have. Like all of you know, I wanted to get this presented because it's timely. So many of the buildings owners that we talk to say they can't use their upper floors because they don't meet building code requirements for safety, and this is the opportunity to really add that fire sprinkler safety system to meet your building codes and get your building in full use rather than so often the first floor. For those of you who are looking at the AIA credits, the first few times I put it in the chat, it wasn't the right link, but the very last one is the right link. So please try that again. And of course, email me if you have any trouble at jbarrett@heritageohio.org. The handouts, this presentation is in the handout box on your control panel, as well as a flyer from the National Fire Sprinkler Association. So I haven't seen any other questions roll in. What I'll say is, while I'm waiting for more questions, huge thank you for our speakers today. But as always, we encourage you to seek appropriate professional help in dealing with complex tax matters. Here we've got a question. Good. Can the presenters offer a high-level version of how this works and a step-by-step? Does one do the work first and then explore the credit or deductions? Or do you do the credit and deduction first? How do you get started? So what's your recommendation for getting people started and actually doing this?
Well, I think it's really talking to your tax advisor about what your plans are, and then they can help you ultimately determine what the best course of action is. I always still tell my clients, I don't let you shouldn't do something for tax reasons. You should do it if you're going to redevelop a building, you should do it because it makes economic sense for you. It's a prudent business decision to make. And then use the tax rules to your advantage to help you maximize your returns. But I wouldn't be advising somebody to do something because it makes tax sense to do, if it doesn't make business sense. But when you have a plan in place, then you get with your advisor and you can kind of evaluate, does it make sense to take historic tax credits? If the building was subject to historic tax credits, for example, or to take a bonus depreciation. If it wasn't subject to credit, then you can still look at the tax benefits and how is it going to help you make the project an economic success. Hopefully that answered the person's question.
And then Tom or Nick, I guess, if it was involving just specifically a fire sprinkler retrofit, for example, or something, it sounds like to me that the most important thing is getting that binding contract. Would that not be correct? As soon as possible.
Yeah, I would agree. Yes, if you're going to be doing it, getting that in place will help you maximize the percentage that you get to claim, especially as you move forward through 2022 and you get closer to hitting that end of the completion date by the end of the required completion date at 12/31/22. If you have that binding contract in place, it gives you a lot more flexibility.
The next question, any suggestions for how local government officials can help facilitate private property owners to make these upgrades and benefit from the deduction credit? Ron, maybe you have some in the field anecdotes that might help this.
Well, Joyce, and I just realized I didn't put my email or any of my contact information on there. Please provide that for them. If they have any questions at all, please feel free to reach out to me directly. And we've certainly got resources available, and we'll be able to help out any way that we could with that.
Do you have any stories of ways local governments have provided assistance with building owners in their community?
Well, for example, I worked for the Lafayette Fire Department years ago. There was some benefits that the government for installing like water mains and so forth. They helped offset some of the costs and so forth. But again, that was years ago. There were some different tax advantages, I think, at the time, or different TIFs. And again, it can get very complicated and complex. But no, I don't have anything like specifically, because it's community based. It's all based upon the different involvement with the community. But again, I think the key is doing these type of things and educating folks and getting everybody in the right room and trying to look at opportunities or things that you can do to try to help offset the cost. So great question.
And Jeff, maybe the question, maybe taking the flyer that is in the handout box, the National Fire Sprinkler Association flyer, and distributing it to building owners on inspections and things like that would be, a first step in making sure they knew they were aware of it. And also, many cities have maybe their own water system that they can put information in the water bill to get that out, because I think that's one of the more critical things, is just making people aware, because then they've got the next barrier. Like Tom said, does it work for them financially?
The simple fact of the matter is that because of the unintended glitch in the bill for the bonus depreciation that didn't get fixed to the CARES Act amendment, and then we're all dealing with COVID. It's really put a kind of a hick in our step here a little bit, So anyway, but still, the opportunity is there for sure.
And Joyce, I would add, and I know this is not specifically on sort of the bonus, but it can be these rules is in the historic tax credit world. It's amazing how many property owners don't even know that there may be like an historic tax credit. So I'm guessing that they probably don't know also that there's these other types of rules. So I think the way the local governments can help is when property owners come in for permits or come in with their plans, is having these in their toolbox and saying, are you aware of these opportunities, other types of programs out there? And you should, get with your tax advisor or get with somebody that knows a lot about these. And it really, it always just amazed me of how many, some of these programs that people just don't know about.
If this is a local fire official or any kind of they can certainly reach out to us too, and we'd be more than happy to help them put their own logo or whatever on it, or with ours, or anything like that. Because again, that's a great point, Tom. It truly is about education.
I love that, being at the building department, so that when people are doing preliminaries or something like that. Well, I think well past 2 o'clock. Thank you all for sticking with us, and please join us for the future webinars. Thank you to the speakers again. So appreciate you providing the expertise on this, and please reach out to me if you need any contacts with any of our speakers. Thank you very much, and everyone have a good day. Bye.
Thanks, everyone.
Thank you.
Thanks.